Thank you, firstly, gentlemen, for doing this. And, the topic for the day, everyone, is riding the domestic investment wave. Now, we've seen record DII investments continue to come through, and we've seen FIIs pull out money again in record number. But it's really essentially why markets haven't cracked is because the DIs have supported the Indian markets. What has changed actually over the last 5 years? That's the first thing I want to most critically understand. And Anshul, let me come to you first with regard to this question, because it's more top down and you would have likely experienced this the best. Tell us, in terms of pure behavior, what has changed? In COVID, for example, there was one instance when someone came and told me that there will be real blood on the street if the SIPs were to stop. That never really happened. Absolutely. And since then, it's been a hockey stick kind of growth where SIPs numbers are concerned. And we see it month after month after month. Yeah, what's driven that?
So I think very, very important to understand here is the behavioral change, as we were you're talking. So when we see a surge in number of people opening Demat accounts and actually participating, it has been exponential. Like till 2020, when we say we had close to 3.5 to 4 crore Demat accounts, which now becoming almost 22, 23 crore in a matter of 5 years, tells us that the kind of confidence the retail investors or individual investors have shown in Indian equities is huge. And that is also visible in the SIP numbers, which is crossing 31,000 crore a month, which used to be around 10,000 crores way back 4 to 5 years. Now, when I look at from the behavior aspect, what I see is that let's look at our parents and what was their behavior when they started earning money or when they were earning. So I was just looking at that their behavior was like maybe SIP behavior, not investing into SIP, but save first, then think of either investments or purchases. So purchases, for making purchases, money was saved. For making investments, money was saved. So savings first and then comes investment and purchase. Now look at the behavior of new generation who is earning money. It is exactly opposite. The word doesn't sound great, PIS, but it's like purchase and investment, they are thinking first, and then whatever left is to be saved probably. So that's where we see that huge surge in investment portfolios, investment money and stable money coming into equities through SIP route. So earlier when we used to talk about that time to exit the market is when retail enters, an age old saying, or retail अंदर आया तो हमको बाहर जाना चाहिए और retail बाहर निकला मतलब that's the time to enter. Now it has completely changed, and that's exactly what we have seen in the last 2 to 3 years, where FII's money is not there, DII's money is there. Markets have not shown any great returns in the last 18 months, but SIP flow, investors coming into the market has not stopped. So I think this behavior change is very, very important to understand, and which is driving these markets, and holding on to the levels today without any foreign money is the structural behavioral change in the retail Indian investor.
So Harsha, if you can add.
Yeah, I in fact was going to come straight to you, Basha, and my specific question to you is that, Mahmood, that when you're looking at the retail investor and when you look at history and investment cycles, they say history does not repeat, but it rhymes. And I want to take a leaf out of Anshul's answer and ask you a question to say that if history is going to rhyme at some point, is there a fundamental change with regard to retail investor behavior, or at the end of the day, the retail investor will still be the one holding, till markets fall? Will that be the case this time around? Will they sustainably, is there a change in behavior basically where the retail investor is concerned?
I think there is a fundamental change at a retail household level. We are finally from a country of savers is graduating to a country of investors. And multiple factors have contributed to it. If you look at the turn of this century, the real returns one would have got on a fixed income product was about 7-8%. So there is no incentive for any retail investor to take risk and invest in a capital market product. But over the last 2.5 decades, the real return on fixed income has come down to 2% or less than that. Sure. And then there is a taxation. So on a post-tax basis, there is no returns one can make investing into a fixed income product. I think that coupled with the fact that capital market over a period of this 20 years or so have delivered a decent post-tax returns, you have a POC. So earlier we used to say equities will help you create wealth, but now you have a POC of that okay, over last 20 years, there are 14% CAGRs is what you have got from broader indices. Actively managed funds would have given you a higher return. So there is do. Third leg is that the awareness level, combination of what asset management industry, the intermediaries part of it, and the media, all of it, what we have done, in now reinforcing this message that yes, if you invest in a capital market product and stay invested for long term, you can make. And during this period, we have seen cycles. I think to come back to this, say that what we are seeing now is a structural shift where people are moving from guaranteed return products to capital market products. Ease of doing transactions is helping them to execute it faster, and we already have a POC of capital market doing well. So I think it's a structural change. If I have seen how investors have behaved in 2008 to 2010 GFC crisis, post GFC crisis, and how did investors behave post COVID, and how they are behaving now. Post GFC crisis, investors went away from the market. They didn't want to stay invested. But there is a lot of maturity retail investors have shown post-COVID. They in fact came and invested more money. This is one of the prolonged period of time correction we are seeing, about 18 months, no returns from the broader indices. But we are seeing more and more investors coming in. I think it is a structural change, and there is definitely reason to believe that the behavior of investors is changing, and we are gradually becoming a country of investors from country of savers.
Okay. Bhavin, Mahmood spoke about how returns have been strong, at least equity returns. The other place where returns have been extremely strong is in gold and silver. And we'd be out of our jobs if this were to continue, right? Talk to us. Is it frenzy, or is this something that is sustainable? And how is the Indian investor reacting to this, in your opinion? You understand and you kind of explain and deal with clients in terms of asset allocation. Are more and more clients coming to you and asking you a question, hey, why didn't you tell me gold was a great investment a year and a half back?
Right. Sure, I think that's been the most interesting, the topic for gold, silver. And I think in last few years, if you go to see, we barely talk and even discuss or think of allocation of gold and silver coming in especially, right? So I think with time, people have now been, of course, see, practically what happens then in the retail or investors, scenario or fraternity, you always look at things, what is there in the limelight, what is catching more attention in terms of returns. So it can be any instrument, but right now we are talking about gold and silver. So what is happening is, structurally, I think, everyone reads this in the news, and what comes in, that the anticipated higher demand for silver in the different spaces like EV and AI and data centers and all of that. And that followed the retail and the speculation, and you know how it is, right? The MCX and the lot sizes and speculation and all of that. So I think, but the way India right now is catching up or kind of leading towards the semiconductor space, the AI, data centers, all of these spaces, I think silver has definitely got a lot of industrial consumption, and hence, because of these upcoming industries taking place in India now, I think fundamentally also one should and can look at investing or having certain allocation as a part of principles and thumb rule of asset allocation, because of course all the asset classes don't perform at the same time. So what becomes very, very important is to have a well-balanced portfolio, making sure doing some kind of active management in terms of having the right assets in a right proportion. And I think when we have the views in specific to any instrument or any asset class, I think that time you can always rebalance your weightages. So I think gold and silver both has got a fundamental justification, and these corrections can be probably looked at, re-entering or probably redeploying if you have kind of done any kind of trades in the past. Because जब तक वो phase out नहीं होएगा तब तक client पूछने ही वाला है आपको that because if one has not invested, he would feel the fear of missing out, the left out, and he would want to invest. So they keep on asking, yeah, why did we exit? Acha, I missed out. Why, when is the right
Bhavin,
time?
this is a good time. This is a good time to deploy if you've missed the bus at, say, 4,000 on the ounce, $4,000 on the ounce when gold was.
One can look at start re-entering and accumulating, not going all out at the same time, but it could be an accumulation. Way of
Gradual.
May I add to what is said. Gold has a role in anyone's portfolio because it has a negative correlation to both equity and fixed income over the last whatever number of period you see. However, it has very limited economic value. It has a place in one's portfolio, but it doesn't generate any income as an asset class. The returns in last 2 years, in my opinion, are not sustainable. So if one investing in gold as a part of a diversification, because it has a negative correlation, help you reduce the volatility, especially in times where you have uncertainty in the economy or there is a geopolitical event, gold is a good hedge. It does that work. But investing, looking at last 2 years return, I would recommend everyone that keep your return expectation at a lower level. There are tailwinds for the gold, and it may continue to deliver good returns, but moderate your return expectations.
Okay. Gautam, finally. So tell us, we've come out of a week where there has been a sea change with regard to Indian policy. One, you've got the budget which has come through. Nothing major in terms of the budget itself. You've also seen the India-EU FTA come through over the last couple of weeks, the India-US trade deal happening. What changes for you in terms of themes, top-down? And what could the next 5, 6, 10 year, maybe the next 10 years in terms of big themes look like, basis the kind of policies that have been laid out over the last 2 to 3 weeks?
I think everything's been very consistent, so if you look at this government and see what they've been talking about for the last 5, 6 years, you're seeing those things play out now. And they've only been consistent in their policy and approach. So obviously with the trade negotiations and the trade deals coming in, you'll see, a lot of impetus to the exporters as well as consumption growing. That is one part of the piece. But on the other side, if you look at what they did with the budget, last year budget, you had a lot of SOPs for the short term, right? But you see this budget, it's all about the long term. It's all about the China Plus One. It's all about building AI capabilities, the EMS space. So it's all about investing in the future and making sure that India is ready to capitalize on that, right? While you can see the news of Anthropic coming in and the IT sector, responding to that. So the government is already anticipating that, there'll be sectors and spaces that we need to take a significant leap in rather than, be another follower. So that's what I'm seeing that the government respond to and work on. Obviously, with the emphasis on manufacturing, infrastructure, and the SME space that they've put in, they've obviously, the investor feels that the government could have done a little bit more on the budget, because short term, everyone is looking for that quick return or some relief.
But enough to kind of build a capex cycle from here. Gautam, you reckon?
No, much more will need to be done. But the point is that they've got their fiscal deficit also. That's something that they are being able to put in control and keep the same target of 4.2%. So they are being able to manage that and yet put in that push wherever is required to kind of ensure that the capex cycle continues. But that is something that is ongoing, and that's why they introduced the REITs part also for the CPSCs. So from a retail investor perspective, I think the sideways market is something that they'll have to contend with, right? 2008 to 2014 is one such example that comes to mind, where I'm talking to clients who've invested and they are sitting on 4% returns absolute for 5-6 years, right? And they're saying, okay, you guys have been telling me about long term. I've invested for 5 years. How much more long term? What do you mean by long term, right? And if you just see point-to-point returns right now, the large and mid-cap space is about 10% plus, but small cap is showing some weakness. It's mildly negative. But as point-to-point performance starts reducing, deteriorating over longer period of times, that's when we'll really see the impact of whether the evangelization of long-term investments, the knowledge that comes with staying invested, all the finfluencers, all that fintech that has done to, let's say, increase financialization of savings, will that actually play out in terms of investor behavior? And I think if you were to break down investor behavior into 3-4 stages, I'm seeing the second stage of investor behavior, where now what they're doing is they're saying, okay, the fund is bad, let me change my fund. Right? Then they'll move on to my advisor is bad, let me change my advisor. And then they'll finally move on to, okay, this asset class sucks, let me, just stick to the gold or the silver or debt.
I can already see Mahmood itching. You want to go for this one?
I agree with what Gautam is saying, that there is this tendency to shift from one to another. But I think among the investors, what I am seeing is that there are investors who are seeing the cycle for the first time, and there are investors who have seen this cycle over a period of time multiple times, and there is some subtle distinction between how they are behaving.
But the new investors are surely in, at least 50% of investors are new investors.
Yes. So they are the one, I want to believe, are the one who will be switching from one asset class to another asset class because they have not seen the cycle. But those investors who have seen the cycle multiple times over last 15-20 years, I am seeing lot more mature behavior, response from their how markets are behaving. So I think even this new set of investors, if they go through this cycle once, will be behaving the way those who have seen the cycles in the past.
Sure. Anshul, has the cycle turned? Have we been here for the last 15 months in terms of the levels at which we've been? Can we turn from here? Do you see that? Do you see the budget? Do you see all of the developments over the last couple of weeks aiding to that turn? Because we saw that initially. We saw a little bit of optimism on Tuesday and Wednesday, and then Thursday again we were subdued.
Absolutely, we are heading for a turn. There is no second doubt about it. As long as your investable surplus is there to be invested in markets, they are there. What we have discounted in these 1.5-2 years also is the money has come to the capital market, but through IPO route. We have around 1.8 lakh crores both the years, this calendar year and the previous calendar year. It is that money is also in some or the other form has entered the market. Now it's a matter of time that when that money also starts moving around. So from that perspective, if you look at it, even with those kinds of dull investments from FIIs and all that, and rupee devaluation, you still have not gone down. So if this just need a bit of a spark which will further start the ball rolling, and I'm very, very confident that we are on a cusp of a situation where we should not hold on our investments, continue our investments, rather the SIP is the best way to invest. I'll rather say gold and silver should continue invest in these metals as well, because silver has a very different usage on the industrial side, and there has been a continuous demand for that physical metal in terms of industrial usage as compared to gold. Gold, India has a different way to deal with gold. So we have much 3 to 4 times more gold than what the coffers in US have in our households. So it's more than 2.3, 2.4 trillion dollar of gold we have in the household. So that will continue holding up. But silver, I'll say, is still a metal to watch because its usage in the industrial products and the domestic products, like आप लोग अपने घर में सब इलेक्ट्रॉनिक सर्किट्स वगैरह खोलेंगे ना, तो 200-300 ग्राम सिल्वर तो निकल ही आएगा उसमें. So that is the usage of silver which is driving it, and it will continue driving it. And equity markets are definitely going to be the great ones in the coming 2 to 3 years.
But you're not encouraged to do that at home. You'll start to see people actually do that. So,
so 27% of the silver is recycled silver, ना? तो आप जो electronic waste बेचते हो उसमें से silver ही retract होता है.
Okay, Bhavin, let me come to you. So, Anshul, let me take a cue from what Anshul said. Invest in everything right now. Equities is going to go up, gold, silver, all good. How do you allocate? I have very limited corpus. So tell me, how should I allocate my corpus?
So see, basically, a very, very well-balanced allocation is required, and I feel that normally what happens that, like he also mentioned that, looking, the time actually when the COVID times, we had lot of new entrants with the demat accounts and mutual fund SIP inflows and all that. And we were post that the one uptick constantly going up, we were all fearing that, with all these young and the, certain age group who has entered now has only seen one side of the coin. And when the other side turns, I don't know, really what's going to happen. So I think what it eventually leads to is that don't get exposed to only one single asset class just because it's going up, and that is what end of the day attracts you at all the times, right? I mean, maybe any commodities or maybe equities or maybe anything. So I think if you start structuring, having a basic thumb rule of not putting everything into one asset class is always going to, safeguard you, because like I mentioned, everything.
But Bhavin, give me the allocation.
So, allocation in percentages is always a little case-to-case basis.
Of course.
But on an average, if you take any mid-age group, I think if you have little bit of longer-term horizon, I think 40-50% should be equities. Otherwise, we will not see any wealth creation in the longer run happening. And then it can be as per what suits you. Maybe 5-10, 5-7%, 4-5% of depending on gold, silver, where they stand. Maybe either it can be in an accumulation way or in any form. And then you have little bit of debt. REITs and a lot of ETFs have come in the play. I think we are still running short of options for ETFs because beyond gold and silver, people are talking that I want to invest in copper now. Copper is the next gold, right? So unfortunately, you don't have independent funds or ETFs where, one can even start, as a retail or HNI start participating. But then what it comes to that, which is in direct correlation as a stock that is available to, because I don't want to miss out on that rally, right? So then you kind of turn around and get to the advisor ki, yaar, copper mein kaise bhi invest karna hai, how to go about. So I think having a well-balanced that, about 5-10% of debt, 4-5%, 7% of gold, silver or any other commodity that you feel that has got a good prospect. And then you have a lot of other instruments like REITs, InvITs, and ETFs. So I think that is broadly how you can structure, and you keep reallocating, because what becomes very, very important is active management and rebalancing your portfolios with time to time, because every small event is going to affect your portfolio in some or the other way. So like how doctors say by regular health medical checkup karna chahiye, वैसे you have to keep that practice in your portfolios also, because it's become very, very dynamic.
Absolutely. Absolutely. So point taken. Gautam, let me come to you. And, let me come to the point that we spoke of a few minutes ago, where you said that in terms of policy, there is a lot that ought to be done. What's missing? What's that missing ingredient, according to you? And what will create the animal spirits at this point?
So, one thing that I don't know to what extent can they fix this from a policy perspective is because, you can control inflation, you can control through monetary policy, you can control rates, and you can manage the savings and investments piece. But currency is something that we've seen we need much more stability on the currency side. And a 2 to 3% depreciation year on year is something that the markets can account for and deal with. But if there is a significant correction, erosion, then what happens is for FIIs, it becomes a bit of a challenge to kind of project returns, and then they have to look at the emerging market basket and have a relative weight for India. So I think currency stability is something that from a policy or from a on a day-to-day action perspective from the RBI side, something that needs to be put more emphasis on. So if that is being able to manage, I think you'll start seeing more significant FII flows coming in.
Okay, I'm actually way up in terms of